Big breaking news from the tech world. Meta Platforms tried to acquire an AI startup called Manus for over $2 billion, but China stepped in and said no. This isn't just a business deal. This is about who controls the future of AI. Meta, a major American tech company, recently announced a deal to acquire Manus, an artificial intelligence firm originally founded in China, for more than $2 billion. However, the Chinese government in Beijing has strongly opposed the deal and is refusing to approve it. In fact, authorities have reportedly instructed Meta to cancel the acquisition altogether. This situation highlights a larger reality. Modern global competition is no longer driven only by military power. It's increasingly centered around technology and artificial intelligence. From China's perspective, allowing a foreign company to take control of a domestic AI firm could risk exposing sensitive technology, data, or strategic capabilities. As a result, Beijing appears determined to prevent any transfer of such assets to foreign entities, especially those based in the United States. So what happens next? The most likely outcome is that Meta will be forced to completely abandon the deal within a matter of weeks. If the company fails to comply, it could face serious consequences from Chinese regulators. These may include heavy financial penalties, strict limitations, or even a complete ban on its business operations in China, and potential restrictions on any future deals within the country. In addition, Meta could become involved in prolonged legal disputes with Chinese authorities. Now, let's break this down in greater detail. April 27, Reuters. On Monday, China ordered US tech giant Meta to cancel or withdraw its acquisition of the artificial intelligence startup Manus, a deal valued at over $2 billion. The directive comes as Beijing continues to closely scrutinize US investments in domestic startups developing advanced and sensitive technologies. This move, issued by China's National Development and Reform Commission, underscores the country's determination to prevent US companies from gaining access to Chinese AI talent and intellectual property. It also comes at a time when Washington is actively working to limit Chinese tech firms' access to advanced US semiconductor chips. An NDRC office responsible for reviewing the security of foreign investments stated that, in accordance with laws and regulations, foreign investment in Manus will be prohibited, and the relevant parties will be instructed to withdraw the acquisition agreement. However, the statement did not explicitly name Meta or any other foreign investors involved. After completing a $75 million funding round led by US venture capital firm Benchmark in May 2025, Manus shut down its offices in China and laid off dozens of employees in July. The company later relocated its operations to Singapore. This transition allowed Manus's parent company, Butterfly Effect, to re-register in Singapore. By doing so, it was able to bypass US investment restrictions on Chinese AI firms, as well as Chinese regulations that limit the transfer of intellectual property and capital abroad. It remains unclear on what legal basis China is attempting to block a deal involving a Singapore-based entity, or how a completed acquisition could realistically be reversed. However, analysts and legal experts say this rare intervention highlights Beijing's strong intent to assert control over cross-border transactions involving Chinese assets, shareholders, or technology under its National Security Review Framework. Weiheng Chen, a senior partner at the law firm Wilson Sonsini and head of its Greater China practice, said that obtaining national security clearance from China will likely become a standard requirement for future cross-border technology deals. The move comes just weeks ahead of a planned summit between US President Donald Trump and Chinese President Xi Jinping, scheduled to take place in Beijing in mid-May. Notably, in January, just days after Meta completed the acquisition, China's Ministry of Commerce announced it had launched an investigation into the deal. At the time, a ministry spokesperson emphasized that all parties involved in foreign investment, technology exports, cross-border data transfers, and mergers must strictly comply with Chinese laws and regulations. Responding to the latest development, this transaction was fully compliant with applicable laws. We expect a fair and proper resolution to the investigation. Meta acquired Manus primarily to strengthen its push into AI agents, advanced tools designed to perform complex tasks with minimal human involvement. Cross-border transactions. According to 5 sources familiar with the matter, Manus's 2 co-founders, CEO Xiao Hong and Chief Scientist Ji Yichao, were summoned to Beijing by regulatory officials last March. Following that meeting, they were reportedly barred from leaving the country. Neither Xiao nor Ji responded to Reuters' requests for comment. However, 2 sources indicated that several Manus employees have already relocated to Meta's offices in Singapore, where work on ongoing projects continues at full pace, despite the travel restrictions placed on the company's top executives. In a LinkedIn post on Monday, Carl Li, a partner at Chinese law firm Zhonglun, noted that Beijing's recent actions signal a shift in how regulators evaluate cross-border deals. According to Li, regulatory scrutiny is no longer limited to the location where a company is registered. Instead, authorities may now consider a broader set of factors, including the origin of the technology, the location of core research and development, the nationality and residency of the founding team, their past business activities in China, data flows, and any offshore restructuring efforts. In sensitive sectors such as advanced technology, transactions may no longer be viewed as routine mergers and acquisitions. Rather, they are increasingly assessed as potential transfers of strategic assets, such as technology, data, intellectual property, and capabilities tied to national security. Amid ongoing geopolitical tensions between Washington and Beijing, the Manus case stands out as one of the latest high-profile examples of China intervening in or blocking a cross-border transaction involving a company registered outside its borders. A similar situation unfolded last year when China publicly criticized Hong Kong billionaire Li Ka-shing's company, CK Hutchison, after it agreed to sell dozens of global port assets for $23 billion to a consortium led by U.S. asset manager BlackRock. The deal was welcomed by U.S. President Donald Trump. Ben Chester-Cheong, a lecturer at the Singapore University of Social Sciences, said the move is unlikely to stop Chinese companies from expanding into Singapore. However, it will significantly raise the bar for regulatory compliance. Companies may now need to demonstrate a genuine shift in their operations, such as where management is based, where intellectual property is owned, where research and development takes place, where data is stored, and whether these activities require approval from Chinese regulators. Earlier last year, after unveiling what it described as the world's first general AI agent, Manus was widely praised by Chinese state media and commentators as a potential successor to DeepSeek. Unlike traditional AI developers, Manus does not build its own foundational models. Instead, it focuses on creating an agent framework that operates on top of existing Western large language models. Alfredo Montufar-Helu, managing director at Ankura China Advisors, emphasized that artificial intelligence has become a central battleground in the strategic rivalry between the United States and China. China is making it clear that it will block foreign acquisitions of assets it considers critical to national security, and AI is now firmly in that category, he said. Is this the start of a full-scale US-China tech war? Subscribe for more updates.